How y'all doing? Good. Good week so far? Yeah. In 3 hours, it'll be pre-break time. So, sorry, John, let me put some pressure on you. Anyway, folks, this summer we wanted to shake things up in our Investment Management Academy, and we were looking for some talent that could really bring some edgy, streetwise wisdom to the Investment Management Academy experience. As you know, especially those in the IMA and in the IBA, the investments area has taken a big hit. The Great Recession, there's still overhang there. And it's still tough trying to figure out where things are going to line up. And John, our great alum who has this accomplished career in Wall Street, stepped up and has literally turned things around. And it's been such a privilege to have John on board. It took the IMA and rebranded it. We've got the investment of IU Capital. And anyway, I just want to thank you, John. And when we were doing Renaissance Week, John's got some great insights. And I told him, come in, John, and give us all the edge. Give us everything, uncensored in terms of what his thoughts are. So he brings a great perspective. And without further ado, I'll hand over to John Succo.
First of all, there's only so much you can say because I got a camera on me, so I got to be very careful here. My students know that you got to be careful what you say, what you put out there on emails these days. Who knows what's watching? It's just a little advertisement. We're really happy with what's happened to IU Capital. I want to talk a little bit at the end about everything I've talked about and how you incorporate that into actual fund management, how it actually works in the real world. My background really is a trader. I'm not an economist, thank goodness. So I ran money. I started a hedge fund in 2001, and it was pretty successful. We ran it all the way through 2008. We actually made a ton of money in 2008. But as a real world lesson, what happened to us was everybody redeemed all at once, because in 2008 we had a tremendous cash crunch. And all the other funds who were losing money, who had traditional type of investments, who were invested in stocks and convertible bonds, were just underwater and they couldn't give money back. So all our investors, half of which themselves were going bankrupt, needed money. So they couldn't get out of the other funds, so they came to us and we were liquid and we gave all our money back. So within 3 months, $6 billion of AUM was gone. So I spent, 2009 and 2010 basically unwinding a very large, very complicated portfolio. And it's just a real world lesson, because what you're going to find is there are no answers in this business. There are a lot of questions. All you can do is get the probabilities to work for you and then try to understand your tail risks. Obviously, the one tail risk, we identified it. We thought it was a probability, but what can you do to manage something like that? So I traded through 2008 and 2009. I have a lot of trading knowledge about it. But any good trader or any good portfolio manager is going to try to develop, number one, an infrastructure to understand and to trade under, and also a real understanding of the values, and in particular his own product or what he's trying to accomplish. And value is an esoteric thing. Value is relative almost all the time. So what we try to do is really understand the relative value of derivatives and how to trade them in a context of a macro kind of theme. So that brings me to what I want to talk about today, which is a macro theme. It's been prevalent in the world, obviously for the past 3 years, but it was there beforehand, just nobody really identified it. Nobody really understood what was happening. And we actually based our whole hedge fund on the premise that we were coming to some kind of conclusion to a very large credit expansion or debt bubble. And how do you deal with the ramifications of that? So in order to understand anything, I think the best way to do that is to go back to the building blocks and to try to understand the evolution of how things progressed and developed. And so the first part of this thing, I just want to talk about a little bit of history. And it's going to get kind of basic because I want to start everybody at the same place. What is capitalism? What is a capitalistic system? How does it work? How does money become involved in that? So the first part is that. And the second part is going to be, where do we stand now? How have we progressed through this financial crisis, and where do we stand at this particular time? Whoops, going backwards. Capitalism. I want to read something to you. How many were here for Jim Grant's speech? Okay, fair amount. Fantastic speech. Jim actually is an economist by training, but he's a different type of economist. He actually, I think, thinks about what, things, the future and what actually causes future things to happen. And I think he thinks in probabilities, which is very important. Anyway, he alluded to the Great Depression, what caused it, how do we get out of it. His take is very, very different, as is mine. He alluded to a book written by Murray Rothbard. Murray Rothbard was an accountant by training, pseudo-economist, but he's very practical in nature. He's of the Austrian bent, which is a very pragmatic type of economics, which is really the one economic thought group that actually predicted what was going to happen. But he referred to a book written by Murray Rothbard, and I just want to read a little bit of the introduction to you. The introduction was written by Paul Johnson. And bear with me. For half a century, the conventional orthodox explanation provided by Keynes and his followers, was that capitalism was incapable of saving itself, and that government did too little to rescue an intellectually bankrupt market system from the consequences of its own folly. His analysis seemed less and less convincing as years went by, especially as Keynesianism itself became discredited. In the meantime, Rothbard had produced in 1963 his own explanation, which turned the conventional one on its head. The severity of the Wall Street crash, he argued, was not due to the unrestrained license of free-floating capitalist system, but to government insistence on keeping a boom going artificially by pumping in inflationary credit. The slide in stocks continued, and the real economy went into free fall. Not because government interfered too little, but because it interfered too much. Rothbard, sorry, it's a weird copy. To make his point in this context that the spirit of the times in the 1920s still had more so in the 1930s was for government to plan, to meddle, to order, to exhort. It was a hangover from the First World War, and President Hoover, who had risen to worldwide prominence in the war by managing relief schemes and had then held high economic office throughout the 20s before moving to into the White House itself in 1929, was a born planner, meddler, order, and exhorter. Hoover's was the only department of the U.S. federal government which had expanded steadily in numbers and power during the 20s and had constantly urged Presidents Harding and Coolidge to take a more active role in the managing the economy. I just want to say real quickly, Harding was president in 1920. This is per Jim Grant yesterday. We had a very severe depression, 1919, 20, 21. What did Harding do? Absolutely nothing. He was a laissez-faire, and he did absolutely nothing. And we came out of this depression very, very quickly. Coolidge, a genuine minimalist in government, had complained for 6 years, that man Hoover, has given me unsolicited advice, all of it bad. When Hoover finally took over the White House, he followed his own advice and made it an engine of interference, first pumping more credit into an already overheated economy, and then, when the bubble burst, doing everything in his power to organize government rescue operations. So Ben Bernanke has his own take on the Great Depression. Obviously, Murray Rothbard has the exact opposite take. So let's start very simply on what is capitalism. And human nature always, you've heard the term trial and error is the mother of all invention. And human beings have built systems throughout history, and if you base them on trial and error and more evolutionary types of things, they tend to be more true. Whereas central planning is a very, very small group of people exercising their power on a very large group of people, which tends to be very inefficient. So capitalism is not a political system, it's just an economic system. It allocates resources. So it's a pure evolutionary force that allocates resources. And it's very just natural, right? What is a market? A market is me and you. A market is me deciding I want to buy something from you at a certain price. Should there be interference in that? And in my opinion, is the less interference, the better. Now, I made this point in one discussion, and someone immediately took that to mean I don't believe in regulation. That's not true. I believe in good regulation. And in fact, our regulators, the Federal Reserve, did very little to avoid the credit problem that we have today. And I'll go into that. What is shadow banking, and how did banks actually get as levered as they did? But let's start with a very simple economy to show the evolution of capitalism. We have two farms, a very closed economy, and they're both self-sufficient. All right? Each farm produces its own food, clothes, and energy. But to do that, it takes almost all of their time to do it, 17 hours. And in this particular case, there's no money. Each farm is producing everything. All right? So we're going to define our standard of living in terms of hours that they worked. It takes them 17 hours a day to produce all those goods just to be self-sufficient. So there are two farms completely separate, doing everything themselves, and basically having no spare time to do anything but work. All of a sudden, both farms realize that one farm is better at something than the other farm. Okay? In other words, farm A is better at making clothes, and farm B is better at growing food. This is called division of labor. Once they begin to barter with each other, hey, I'll give you some of my clothes and you give me your food, they realize that because one is better than the other, and that division of labor has created a situation where now they don't have to work as long. So now they only have to work 15 hours a day. That's an increased standard of living. They're better off. There's no money here. They're just better off because one person is better at it than the other. In other words, it's a form of technology and production. That's what production is. The resources are exactly the same. The production has increased, and their wealth or their standard of living has increased because now they have 2 extra hours a day. And we continue. All right, we go from a barter kind of situation to a trade economy. In other words, there's more participants. We have a new farm in town. He happens to have a great way to cut down wood and to make it into energy. So we trade. Farm C now provides all the energy for the other two farms. Farm A provides all the food. Farm B provides the food, and Farm A provides the clothes. Another division of labor, same exact resources, nothing's changed. Production is increased, and the wealth is increased. Again, no money. And any questions? I know this is simple stuff right now, but any questions, just pop in there. I'm having trouble with this. Okay. So we have a trade economy, and it's very difficult. Okay, everybody's carrying around stuff. No one, it's very difficult to trade. So what they do is they just define all of their goods in terms of money. They can have toothpicks. It doesn't matter. As long as you have a finite number of money, you can then divide that money and assign a value to that money. So it just facilitates trade. That's all it's really doing. It's not doing any other function except it is an arbitrary facilitator of trade. There is a money supply now. They've all decided, hey, we have this much gold, let's divide it up, you get this, you get that, and now we'll start exchanging in money instead of directly in goods. So money acts as a store of value here. In our little closed economy, we have the money supply, the total money is now equal to the total value or the standard of living. There's total wealth in the economy. What happens over time is that one farm, they have more valuable things. Through preferences, through people's preferences, people decide that, hey, C stuff is more valuable. So C begins to accumulate more income or more of those coins that are in the economy. It gets wealthier. So we have an income distribution. Now we have certain farms having more wealth than other farms. The overall wealth in the or the overall coinage in the system is the same, but the wealth now is being distributed a little bit unevenly, just because certain goods are more valuable than others. But the total money supply has remained the same. That has not changed. Now C can do one or two things with that extra money. Okay, he can save it. Actually, he can do a couple things. He can save it or spend it, all right? But now we're going to give him the ability to lend it, all right? So C has all that he needs. And so he can put the money under the mattress, or he can figure out something else to do with it. Instead of buying more stuff that he doesn't need, another farm who just came into town says, hey, I have a new way to grow food that's better than what you have. It's going to make people less sick. People are going to want it more. But I got no money to plant a field. I need some resources. So C can now say, well, I got some extra money. I'll lend it to you. And that's an investment. All right, so C lends F the money to build his farm, to produce better food, which he then begins to distribute to the rest of the community. And he's going to eventually start making money on that. But for this, but before we go to that, notice how the money supply is unchanged, but all we're doing is converting a portion of the savings into credit. So C is giving up his savings, which is transferred to F. F can now spend it, right? But it's now classified as debt. But the total liquidity pool has not changed. And savings equals investment. That has not changed either, because all of the production is being financed from a saver. Now let's introduce banking. Did I skip one? I'm having real trouble with this thing.
Try using the clicker to advance the stuff again.
Can I go back?
You may have to go to the keyboard to go back.
You want me to drive, please?
Okay. All right, and this is just the next slide showing that as F built his farm, he's now collecting income. All right, so he still has the debt. The debt is still there. He hasn't paid the loan back, but now F is earning income. So I show that by his house getting a little bit bigger. He's taking income away from B and E, or he's taking coins away from B and E because they're buying his stuff. But the overall level of standard living is not changing for B and E. It's just that the amount of coins that they have, which is less, is buying more, okay? Because production is increased and things are more valuable in a way that their coins buy more stuff. So the prices have actually gone down in that case, because when you have a certain amount of money that buys more things, the price is going to go down. Now, let's just introduce banking. The first banks were really the Greeks, 400 BC. And they used their temples as banks. And then Romans had banks. The interesting thing about Romans is that we use a lot of our law from Roman thought. And the one huge difference that Romans had about banking was there's two kinds of deposits. There's time deposits and demand deposits. Demand deposits they considered to be personal property. There's two types of demand deposits, regular and irregular. All right, a regular would be, I want to deposit my mom's ring at the bank. That means I need that ring back. Right, so it's just safekeeping is what it is. So I need that particular asset back. That's a regular deposit. An irregular deposit would be money. So I don't have to get the exact same dollar bill back, but I have to get something back that's an equivalent value to it. So, but Romans considered a time deposit a loan to the bank. In other words, you put your money on deposit at the bank, I'm going to get an interest rate, and I'm letting you know when I need that money back. The Romans considered that a loan to the bank, and then the bank could then loan that out for that exact period of time and earn a spread on the difference that they were giving for interest from what they were charging. Demand deposits they did not lend out. They felt that that was illegal, that that was personal property, and that you could not lend out irregular demand deposits. So here we just have a simple model of how the banks, a depositor would deposit either a time deposit or demand deposits, but the banks at that particular time would only make a loan at the time deposit. So in this particular case, where the bank introduces a very simple model, we have, again, total money supply, it hasn't changed. The amount of savings is the same. The investment or the lending is completely done by the time deposits or the savings in the system. And if we built a modern economy based on that, and some people have advocated this, going back to a gold standard, a 100% reserve requirement for banks, which means essentially that they can only lend out time deposits and only lend them out on a non-fractional basis and only lend them out for the term in which they have that loan or that time deposit. Now, real quickly, has anybody ever noticed sweeps? Does anybody know what a sweep is? Yeah, Cole, you know what a sweep is. Tell me what a
That's
sweep
where
is.
they sweep the money into an account and take it out.
Okay. If you look closely at your checking account, every night they sweep the money out of your checking account and put it into a savings account or a time deposit. That's because there's no margin requirements on time deposits. And I'll show you how those time deposits, that can create infinite money when you go through a banking system. But the time deposit has no margin requirements. So in an effort for banks to even lever more, and in today's world, you can lend out a demand deposit, but you have a reserve requirement against it. So in an effort to lend out even more, they would sweep your money every night into a time deposit and then be able to lend that out. Just another function of it. What I've shown here, though, is, and I want, if you want these slides, I'm going through them real fast. If you want these slides, I want to give them to you as further reference. And what I did is I just built a very simple model of the economy based on what we just talked about, which was an Austrian-based banking system where you have no fractional reserves, you have limitations on what you can lend out, but the banking system is sufficient. That liquidity is sufficient to create production in the economy. Now, we've had arguments, was it always like this? If you needed money, let's go back to 1820. If you needed money in Montana, did the banks in Montana have money? Probably not. So people argue for a central bank that could fund those banks out there and take resources from other parts of the country. So central banking might have been a necessity when communications and the transfer of money was much, much less efficient. My argument is in today's world, with very efficient transfers of money, very ubiquitous communications and ability to move money around, you don't even really need central banking. And so this model is very simple, showing that the liquidity created by savers is sufficient going through the banking system to be lent out through corporate loans and consumer loans, which creates some consumption, but mostly production. But in this particular case, one very important point, the savings by price or interest rates is creating a natural rate of interest, right? This is something that's very important. The natural rate of interest is what the market determines based on where, how much money depositors are willing to deposit, what the interest rate should be for lending, right? So let's say that we have some very productive borrowers out there. They have some great technologies they want to invest in. The bank and investors are willing to do that. But let's say we've done all that, becomes less productive. We have certain, people still want to borrow some money to build extra condos, but depositors or investors realize that that's an unproductive use of the money, so they don't want to lend money to that, or they raise their interest rate for it. So it's a process by which the market itself is determining what the interest rate should be. What should we charge any particular borrower, and what risk the lender should take. So it's all done by the liquidity is created by the saver in this particular case. Okay, now we're going to get into fractional banking, right? And fractional banking was first created, I wouldn't call it quite fractional banking, but everybody's heard the Medicis, okay, the Italian bankers in the 1400s. Okay, it took 100 years, but the Medicis did go bankrupt. And the way they went bankrupt is they became, what do you want to call it, greed or whatever, but they became much more aggressive in how they lent their money out. The first thing they did, they lent out time deposits, okay? But they would also lend out time deposits at various lengths. In fact, past where they knew their loans were going to, when they had to pay back the money, just thinking that new loans were going to come in. The other thing they began to do is actually lend out demand deposits. And they lent basically all of them out by creating notes themselves that people could trade upon. So it wasn't the fractional banking system that we have today, but it was the precursor to the fractional banking system. In other words, lending, for the very first time, they were lending out what was previously considered personal property, and they were doing it on a levered basis. They would just keep a very, very small amount of money to cover what they felt was the experience of people coming in. And the way this would fail, very simply, would be just loss of confidence. If people just said, oh, I heard the Medicis don't have enough money, all of a sudden, wham, okay, everybody's at the bank trying to get money out. It happened several times, and eventually the Medicis went bust. But what it does is it essentially lowers that natural rate of interest to a levered natural rate. We're still funding all the liquidity from savings, but we're doing it much more aggressively. And so you'll find on margin, interest rates would be lower because the Medicis want to lend out more money. And they want to do it more often. So the liquidity pool is expanding, but still we're being funded by savings. Okay, this is where our current system lies. Okay, what I've done here is we're going to introduce now true fractional banking. We're going to do it before, there's no central bank yet, but this is what fractional banking is. So I need some, let's use this row right here, okay? We're going to go through a little experiment. You're my bank, okay? Here's $100. I tried to get real money, but nobody had any singles, so couldn't really do it. All right, so I just gave him $100. All right, I just deposited $100. There's only $100 in this room, okay? That's it. So now my bank is $100. All right. Now, your reserve requirement is 10%. All right. So now you have $100 on deposit. How much money can you lend out?
$10. Oh wait, 90.
Right. You can lend out 90. So lend Ryan $90. Okay. Now you have $10 on. Still have $10 as reserve requirement at your bank. You now have $90. Right. You have $90 deposited at your bank.
81 for him.
81. Well, you deposit all 90.
I give him all 90.
Well, you're depositing money.
Okay.
Okay, so you give him 90. Now, this bank has $90 on deposit. Now, you lend him money. How much can you lend him?
$81.
Okay. So you have $9 on deposit as collateral, or as a reserve requirement. You have $81, right? You take your $81 and you deposit it at your bank. Okay. Now, how much money do we have in the system now? How much money do you have?
90.
How much money do you have? 81. We have $171 of credit created for my $100. Okay, and if we kept going all the way, right, we would have $10,000 of new credit in the system. All right, basically just the reciprocal of the reserve requirement. So I just showed you very simply how the fractional banking system works. Because they only have to keep a certain amount on deposit, but when you deposit money at a new bank, that is now considered capital, right? And in fact, when we introduce a central bank, the way it would work is loans usually occur first. So if he needed capital, if this bank needed capital, he would just get it from the Federal Reserve. But that's how the fractional banking system works and how it creates credit out of, an iterative process of deposits. Now notice what's happening to our money supply now. Our money supply, or our liquidity pool, okay? Money supply is a misnomer. Money supply, you could include credit in the money supply, but remember what the Federal Reserve did with M3, okay? They don't calculate M3 anymore, all right? M0 is, specie, which is coins, and money held at reserve at the Federal Reserve. Okay, so that's very high-powered money. All right, and that's what the Federal Reserve can create by lending, at the very least they can create that. M1 includes demand deposits. M2, a little bit more, time deposits. M3 starts getting into credit type of activities. So I find it convenient that the Federal Reserve eliminated the calculation of M3 because in today's system, all right, when we print money, when people say we're printing money, we're not printing money, we're creating credit. All right, I just showed you how we did it. That's what we refer to as printing money, how the credit system expands. So there's not all these new dollar bills running around, but people have access to credit. And this is what I've done here is this is the modern economy using fractional banking, right? And all I'm doing here is showing that now we have a levered natural rate. Now it's still being determined by the market, okay? It's still being funded by a saver, but the extra credit is being created through a iterative process of banking, all right? So we have a levered natural rate, which would basically drive rates below a natural rate and induce borrowing and spending or lending. So our corporate line, we have more loans going to less productive things. Just by definition, as you lend more, you're going to start lending to less and less productive endeavors, or lending for less and less productive assets. So we might start building extra condos that we don't need, or extra strip malls that we don't need, just because people have access to credit at a lower rate than the natural rate. Now I just want to introduce the central bank. And the central bank basically can't create credit in any great degree or any great multiplier effect without our little banking system. Okay? If I'm the central bank and I give this bank money, I give him $100, but he doesn't lend it. Okay? He takes that $100 and either sits on it. Most likely what he's going to do is he's going to deposit it back at the Fed or something. He doesn't want to lend it out. For whatever reason, he doesn't want to lend it out. That's where it stops. Okay? So every dollar that the Fed's balance sheet increases, and I do that through a repo. Okay? He says, I need money. I said, okay, give me collateral. I take collateral, and I give him credit. I get the credit out of thin air. I make it up. My balance sheet expands. Okay, so my balance sheet goes up by $100. I owe him collateral, so that my liability is collateral, and my asset is my loan to him. That's all that happens. Okay, that's where it comes from. It's magic. So he needs to lend that money out to create a multiplier effect. And in fact, this is what Bernanke's been talking about. They can't print enough money. Hyperinflationists are afraid that the dollar is going to go to zero very quickly. Okay, well that would take a huge amount of lending released from all these reserves. But it's been proven statistically time and time again that you can't force people to borrow. You can't force them to lend. If they don't have the capability to borrow, that money that I just gave that bank is just going to stay at reserve. He's going to just put it right back in reserve to me until he needs to lend that money out. But the important point is that now we have an artificial rate. The thing that changed on that graph now is instead of a levered natural rate, we have an artificial rate. I am the central bank. I am 15 people that is deciding what interest rates should be in this country. And you go back to my first statement, what capitalism does and markets do is it has millions and millions of people making those decisions. I don't want to lend my money at that price. I'm going to keep it safe. Well, when that happens, maybe what's happened in the economy is we've reached some plateau of productive lending. And we're going to demand, and market participants are going to demand higher rates of interest to take more speculative loans. Okay? Well, what the Fed does is they say, no, we're going to lower interest rates. And we're going to find speculators who want to borrow that money. Now, our bank, let's call him JP Morgan, may not want to take that risk, but when he sees the Federal Reserve be insistent, keeps lowering rates, okay, or other things like Fannie Mae and Freddie Mac guaranteeing loans, JP Morgan becomes convinced it's called moral hazard. JP Morgan becomes convinced over time that even if he takes that extra risk, he's going to be okay because the Fed's going to be there for him. And so he goes ahead and makes that loan. Right? But that's what it takes. It takes an artificially low rate to induce speculators to borrow to produce less and less productive assets. More and more condos, more and more strip malls and things like that. Well, that wasn't the last thing, okay? The Fed had eliminated the gold standard in 1971. Well, the Fed didn't, but Nixon did. They eliminated the gold standard in 1971, which allowed the U.S. balance of payments to do whatever it wanted to do, and allowed banks to borrow more money. So that was a restriction that went away. The Federal Reserve in 1987 under Greenspan lowered reserve requirements on banks to accommodate the 87 crash. They also guaranteed basically all the broker-dealers in Chicago that were levered up. So the Federal Reserve, which is responsible for regulating banks, allowed something else to happen, which is something called a shadow banking system to occur. All right? Shadow banking is simply having risk off your balance sheet in one form or another. And the predominant way that they did that is through the derivatives market. The derivatives market, the biggest component of the derivatives market is the swaps market, interest rate swaps. It's now, I won't tell you yet how big it is because I want you to see for yourself. But an interest rate swap is allows banks to increase the size of their risk or hedge their risk, but there's a lot of speculation in there as well. So for example, the interest rate swap market is basically a fixed for floating market. So you can make bets that that interest rates are going to go down or up by making a swap bet on a fixed or floating rate. But what it does is the biggest risks are still there. In other words, the risk of interest rates going up or down will be shown as profits or losses in the swap market. And so that when a bank makes a loan, yes, it has credit risk, but it also has interest rate risk, which is actually probably the biggest risk. So the swap market is a conduit to allow the banks to not show this risk and to keep it off balance sheet. And it became, as you'll see, incredibly large. And what I did, again, just take this home at your leisure and you can look at it, but I just created another schematic of what an economy would look based on this Keynesian type of activity, which simply means that every time the market itself wanted to slow down and it didn't want to make that next loan, the Fed would step in and say, no, we have to increase aggregate demand by either having the government spend more, lowering interest rates, and finding speculators to borrow more. So this was the 1990 liquidity pool. 22.8 trillion, fairly balanced. The derivatives market was large, but it was comparable. We did have a relative size of savings to support this level of debt. It was still fairly levered, but we had something there. The 2001 liquidity pool, much, much larger, $170 trillion. And also notice the size of the derivative market. So what's happening here is the swap market, even though bank loans and everything else is growing, the derivative market is growing exponentially at this point, which is a levered liquidity pool. And here we are in 2008. Okay, just gives you the size, or it makes you understand the magnitude of the problem. They had stuffed so much debt into the system through the mortgage market by making loans available. Those loans were made available. They never would have gotten made if it wasn't for Fannie Mae and Freddie Mac guaranteeing most of those loans and buying a lot of those loans. This is why Fannie Mae and Freddie Mac are in receivership now. The ultimate problem in Fannie Mae and Freddie Mac could be as high as $3-4 trillion, depending on how the economy works its way out. But just look at the size of this liquidity pool relative to the actual savings supporting it. Now, what happens when you get to this size of a liquidity pool is you simply don't have enough income to support it. In other words, you built all these condos. Half of them are empty. They're not producing income. You built all this office space. Not all of it's rented out. You don't have enough income going to pay off this debt. So you have, for a while there, we were trying our best. Remember, like in the fall of 2008, I think Bush got on TV and he said, "Hey, if we don't bail out the banks, we're all going to die." So what he was really saying is is that the banks ran out of collateral. In other words, they had levered themselves up so much that he had no collateral left to give me for any more repos. Okay, he ran out of treasuries. So remember all the things that happened for the government to try to keep this, and what I'm going to explain in a second is that I want you to think of it a little bit different way, all right? I want you to think of inflation not necessarily as prices going up, but think of as inflation as inflating the money supply or inflating the liquidity pool. When you create credit, people have more money and they spend it, and they drive prices up. So as the credit pool is expanding, you naturally have a rising asset prices, stocks, risky assets, consumer goods, because people have more money to spend. So by definition, an expanding credit pool, which is how I view inflation, will increase prices. So people have come to know inflation as increasing prices. But what deflation is, in my mind, would then just be the antithesis of what an inflation is. And inflation is inflating the money supply. And at some point, you're inflating it with extremely artificial means, any way you can. Deflation is just a corrective process. It's saying, hey, we have too much debt, we need to get it down. We either need to forfeit it or pay it off or something, but we need to get it down. The first thing we're going to do is we're going to stop lending, okay, which is what happened. Now, the government has done everything they can to keep this deflation or corrective process from happening. All right? So when he ran out of treasuries, me being the Fed said, well, I got to get money in there somehow. Let's do TARP. Okay? And what TARP was that instead of him giving me treasuries as collateral, I am now willing to accept a lot less pristine collateral, like I'll take car loans, I'll take consumer loans, all the stuff that's on his balance sheet, I'll take. And in fact, they actually took stocks. So even when stocks were on his balance sheet, they took stocks as collateral. All right, so that freed up, that arrested the deflation because now I could get him money. I could lend him money. Remember, the Fed never gives money away. The Fed lends money. And for anybody who's worried about hyperinflation, and I actually had a very good discussion with Jim last night about this, I don't think that there's going to be hyperinflation until there is a real problem in the economy, like if the S&P went way down again. Yeah?
What happens if those assets on the Fed's balance sheet turn out to be non-performing?
They can monetize the losses.
Okay.
So at some point, if they feel that the value is impaired, they can, and they can actually go sell them, take the impairment, and monetize the loss. So the Fed per se can't lose money. But that being said, the Fed also, in my opinion, this is why I don't think there's going to be hyperinflation. A central bank has never, ever, ever in the history of the world created hyperinflation. It's always been created by a government because a central bank lends money. All right, when you lend money, it has the auspice of paying it back. Right? So you just don't think, okay, so there's a little disconnect between money being worthless and money not being worthless. When a government gets control of the money supply, they give it away through transfer payments, welfare, things like that. And the more they give away, that the next incremental dollar being given away, you begin to wonder, where's, these guys are giving me money, they must be giving everybody money. And that's when a hyperinflationary type of event could happen. So you'd actually have to probably see the Federal Reserve relinquish control of the money supply for actual hyperinflation to occur. And that may actually happen if things get bad enough. So you have deflationary forces, and that's what the Fed is. The Fed and the government are fighting these deflationary forces. They don't want these. They don't want deflation. Jim made a funny comment yesterday. He said to the Fed, deflation is 1.5% inflation. So, it's insidious in my mind for the Fed to target 2% inflation. Why do we need to have 2% inflation? Okay, the bankers love it. Companies love it because as you expand money, what tends to happen is prices are rising. And if you own assets and the prices are rising, you're maintaining your wealth, right? But what if you own income? what if you're a normal guy earning, $150,000 a year? Maybe that's not normal, maybe $50,000 a year, right? That $50,000 a year is worth less and less and less. Okay? So, just compound 2%. I think Jim did it 2% since Cleopatra, and it was like 5 trillion or something. I don't know. But, 2% a year for 30 years, compounded for 2% is huge. And so, over a 30-year period of time, if you're a normal Joe earning a salary, your relative wealth is going down vis-a-vis people who own assets, whose wealth is going up relative to yours. And so to me, targeting 2% inflation is pretty insidious. So again, this is explaining that inflation is inflating the money supply and deflation is simply deflating that money supply. Now, all this plays into currencies, right? If the Federal Reserve is going to insist on devaluing the dollar, which is, by definition, increasing credit, right? When you increase credit, you're increasing the number of dollars in the system. When you increase the number of anything, you're decreasing their value. So as you have more and more dollars, they buy less and less. So vis-a-vis the rest of the world, if the Federal Reserve is going to continue to do this, the dollar is going to weaken versus another currency. This is the way it happens. So let's say I buy shirts from Japan or China. Let's say Japan. Let's say I buy a car from Japan. I pay in dollars. The Nissan doesn't want dollars. They want yen. Right? So the first thing they do is they take my dollars and they go to their bank, Japanese bank, and they say, I want yen for these dollars. Okay? So it goes into the Japanese bank. The Japanese bank then goes to the central bank and says, hey, we need yen for dollars. We need to sell you our dollars and buy our yen from you. Right? Well, the Bank of Japan has two ways they can deal with that. The first and simplest way would be for them to go into the open market, sell the dollars for yen. But what would that do? That would weaken the dollar versus the yen. So the yen would strengthen. The car that I just bought would become more expensive to me, and I may not buy a Nissan car. I may buy a Chevrolet instead. So Japan wants to keep their exports going. They want that Nissan to stay cheap relative to the Chevy. So they don't want the yen to appreciate versus the dollar. So they sterilize it. And the way they sterilize it is they print the yen, they give it to Nissan, they take the dollars, and they go buy U.S. securities with it. And these are Forex reserves. Okay, so they maintain the dollar exposure by investing them in U.S. denominated assets, which could be, one of the things the Japanese and the Chinese were buying in great amounts was Fannie Mae and Freddie Mac paper. So they weren't just buying treasuries, they were buying Freddie Mac and Fannie Mae paper. Those things went into receivership, and notice how quickly the U.S. government went in and said, don't worry about it, we got it covered. Because if they hadn't, there'd been, all hell would have broke loose with this. But we've been able to keep these imbalances going because of this sterilization. Long ago, the U.S. may not even become the world's reserve currency. Now, we officially became the world's reserve currency with the end of Bretton Woods in 1971. But an effective reason why we're the reserves currency is just because we buy more stuff than everybody else, and everybody has our dollars on their balance sheet. That's why we're the reserve currency. We've been able to create an immense amount of dollars with very few repercussions to it. But what's happened is that the U.S. debt, which I'll show in a few seconds, is untenable. And this process of export-import has pretty much allowed that to continue. So here's our current state. Do I go to 215? Okay, U.S. debt as a percentage, whoops. Okay, sorry about this. I'm not very good with this. Okay, U.S. debt as a percentage of GDP. Just notice 1933, the all-time previous high, almost 300%. We are still at 350%. After all this thing, all this stuff we've been trying to do, we haven't done a thing to our debt problem. Now, what's happened is that federal debt has increased and private debt has decreased somewhat. All right, and you'll see that most of that debt is financial debt that's gone down on the private sector. But all we're really doing is transforming private debt into public debt, just like Japan did. Long-term interest rates, I want to give just a historical perspective. Maybe we're a little bit lower here on the long-term debt now. We're closer to 3%. But rates have been extremely low in the past. They were low, from the Depression as well. So it all matters. What happens is that people take money out of risky assets and put them in riskless assets. And that's what's happening right now with the Treasury. We know that China is actually a net seller of our debt at this point. Why are they a net seller? It's not because they want to sell it. It's because they're not getting as many trade dollars. Right? If you don't get as many trade dollars, you don't have to immunize. So you're not buying as much outside treasuries or other securities from the United States. So as some of them go off, by definition, your amount of foreign exchange is going to shrink. And that's exactly what we're seeing in China. But that's being made up by US investors buying more. Right? It's coming from the traditional retired person who can't get any money on his CDs. When he goes to a CD, his bank is getting 40 basis points now. So he wants to get something, so he's going up the risk curve. So he's going out longer in maturities. They're going out in riskier assets like stocks and junk bonds. But that's what's being forced here is because interest rates are essentially zero on the short curve, just normal people like retired people are being forced to take much more risk with their money to make any kind of return. So when you see the stock market rally, it may not necessarily be because things are getting better. It just means that more people are taking money out of riskless assets and putting them into risky assets. And again, I'll just leave these charts with you. The Federal Reserve deficit as a percentage of GDP, huge deficits. I don't believe the numbers coming out of Washington. I think the deficit numbers are much worse than what they're actually talking about. But we'll have to wait and see. This is U.S. debt as a percentage of GDP, including gross debt, okay, which is just money the government owes itself, approaching 400%. Annual borrowing by sector, you can see the private is increasing a little bit, but it's come off of a really sharp decline. Public debt, they're trying to slow down. At least the deficit numbers that they're putting out are saying that we're going to be borrowing less. Again, I don't believe them, but that's what they're saying. A little anecdote here. All this increase in private borrowing lately has been student loans. Okay, and so if you look at the last credit report, revolving credit, which is credit cards, increased somewhat. But if you look at the actual consumer expenditures, they didn't increase. All right? Again, a lot of people take one point of data and they lean on it. Oh, that's bullish. Okay, revolving credit increase. People are borrowing money in their credit cards. Okay? The problem is they're borrowing more money in credit cards, but they're not buying more stuff. Right? They're having to go to credit cards just to maintain what they currently are buying because prices have gone up. All right? Non-revolving credit, which are kind of loans, increased by $18 billion in January. 13 billion of that were student loans. Right? And of that, the largest increasing sector were the age group 39 to 50, which means that people who are considering themselves permanently unemployed, can't get a job, are going back to school, trying to change their lives, which is not a great idea. Total domestic non-financial, again, just another chart showing the extremely elevated level of private debt and public debt increasing. Just another chart as a percentage GDP. I hope I'm not ruining everybody's day. You know, we do have spring break. Again, more charts. Total credit market debt owed, extremely high. M1 stock going through the roof. This is, M1, a function of, this is really a function of M0, okay? M1 includes M0. I'll explain that in a second. Okay, M1 multiplier going down huge, right? The difference between M1 and M0 are demand deposits. So what this is basically saying is, even though the Fed is lending JP Morgan tons of money, okay, they're not lending it out. They're just simply putting it back on reserve, back with me. Right? So demand deposits are not expanding while M0 is expanding. Velocity money, another measure. Okay? We are now just coming down to a normal level, which is not a good sign. If the velocity money cannot support the economic activity given the level of debt right now, as it's come down, it's going to be even worse. So hopefully we stabilize somewhere around this number. But if we continue to go down, it just means that people are simply sitting on their money, not doing anything with it. These are a lot of notes. I'll let you read them at your leisure. The big thing I want you to get from this is that Keynes had a certain opinion, and Milton Friedman had a certain opinion, that the real problem with the Great Depression was the government didn't do enough, that they didn't do enough to stimulate aggregate demand. And that's, you have to do as much as you can to arrest a debt collapse. What Irving Fisher basically says, very simply, is you just can never have a debt bubble. You know, that's how you control it. You never let yourself get to the point where there is a debt bubble. And that debt bubble is created through fractional banking and bad policy and bad regulation. You know, there's definitely not been enough criticism of the Federal Reserve for the lack of regulation of banks during this whole period of time. Here I just gave you some different money supply, money supply, what they are, so you can look at that at your leisure. Personal savings rate. The personal savings rate has to rise to pay back debt. Okay, it rose for a while, but now we're having a lot of difficulty because people are trying to maintain their standard of living, so they're really having trouble saving their money. This just gives you an idea the relative amount that the government of the U.S. has now become part of the economy. The U.S. government is very inefficient. The resources that they use are immense relative to the productivity that they produce. In fact, there are several economists that I listen to that think that government spending has a negative multiplier, that eventually it actually is a drain on the economy. Maybe not right away, but it becomes a drain on the economy. Real median household income, okay? It's the lowest since 1995. That's got to go up. If we're going to pay back these debts, that's got to go up. Real consumer net worth just going nowhere. This is the rate of growth. So we had a huge decline in 2008 and 2009, and we really haven't recovered. We're not in this alone, okay? This is a global phenomenon. In fact, there are areas of the world that are actually slightly worse than we are. This is the UK versus the US. So UK has even more debt than the US does as a percentage of GDP. And God forbid GDP starts to drop, because then you have a real problem. Total Eurozone, total debt outstanding as a percentage of GDP. Again, they're worse off than we are. And here we come to the king of kings. Okay, Japan. Astronomical. So I just threw in a few more charts. And it's getting worse. In other words, if the US debt, okay, let's call it 14, 15 trillion all in. If interest rates go up by 100 basis points, we have another $150 to $200 billion of interest that they have to pay. So they have to keep interest rates low. In fact, the average duration of the US debt, I think, is like 2.5 to 4 years. We're not even looking at 30 years. We just keep borrowing short and rolling it. It's a very dangerous game. So if for some reason we're not able to roll that debt at the same interest rate, and our interest rates go up by 100 basis points, we've got a problem. We've got another $150 to $200 billion of extra interest expense that we have to pay. And what this is showing is that Japan's gone, they've gone plaid. Anybody see Spaceballs? Okay, Japan has gone plaid. In other words, they are now at the point where their interest is eating up all of their revenues. And so they're past the point of no return. And in fact, at IU Capital, we're looking at getting short the yen here. Because the Japanese have, we have about, some people think it's about 80, but I think it's more like 100% government debt to GDP. As comparison, Japan has 220% government debt to GDP. Why do they have so much more? Because they did the same exact thing we're doing. All right, their banking system failed. They took all that bank debt and they put it on their own balance sheet. Okay, so now that's why they have government debt. We're doing the same exact thing. Although right now we're putting it on the Fed's balance sheet. Okay, but believe me, somehow that's going to get to Fannie Mae and Freddie Mac or some of these other things, and then the government's going to bail that out. It'll be on the government's balance sheet. So, mark my words, it'll get there somehow, right? But Japan's past the point of no return. So they have been financing their government debt internally by selling it to their individual citizens who are savers. The problem is now is Japan is getting older. Their people can't buy those JGBs. In fact, they're going to turn net sellers of JGBs just to finance their standard of living. So the government of Japan is most likely going to have to go offshore. They're going to have to sell yen debt offshore to finance their debt. As soon as they do that, if I'm a US guy and I buy a yen bond, I don't want yen. I want dollars. So the first thing I'm going to do is hedge the yen. I'm going to go out and sell the yen against the dollar. So that'll put pressure on the yen. So one of the things we're looking at is putting a position on being short dollar yen. Now the yen has been extremely strong. Extremely strong. Why? Okay? Not for good reasons. It used to be when a currency was strong, that was good. It meant that flows were coming into the country. Nobody wants a strong currency right now. They want to grow their economy by exporting. Right? So everybody wants a weak currency. Right? In Japan, they're the greatest inflationists who ever existed. Okay, back 100 years ago, the yen was on par with the U.S. dollar. Right? So they know how to inflate. And at some point, and we're already starting to see it, they may inflate pretty aggressively. Again, Japan's debt growth is just untenable. It's explosive. This is just another chart illustrating that. And what has been the response to all this? These are central banks' balance sheets. Okay? Bank of China through the roof. All right, China's no miracle. That's a completely another story that Jim touched on quite effectively yesterday. But China basically controls their banking system, and they tell them who to lend to. It's extremely unproductive. It could be a big problem in China as well. But this shows you how central banks are expanding their balance sheet in a tremendous amount, trying to maintain that liquidity. But it's my contention that you would have to see the Fed's balance sheet not double or even triple, but go up by a factor of 10 or 20 to create hyperinflation. Now, a central bank is a private institution. They have shareholders. They had a balance sheet. It's my opinion that they're just not going to do something like that. And you can already see how Ben Bernanke talks like Humphrey Hawkins. It's the government's fault. You have to get a hold of your deficits. Please get a hold of your deficits, because I don't want to expand my balance sheet anymore. And this is just the 8 central banks all told together, the incredible rise in the size of their balance sheets to deal with the credit problem. But they haven't dealt with it. They've just kicked the can down the road. They're just trying to maintain the situation. Same thing. And just lastly, so Iran money, how do I deal with all this? And it always kind of surprises me that you have funds out there or investors that don't even look at what the macro situation is. A macro situation won't have, you could go 10 years without any implication from a macro situation. We became extremely concerned about the debt bubble back in 2006. Okay? But if we had gone out and shorted everything in 2006, we had 2006, we had 2007, we had the first part of 2008 that we would have had to deal with. We dealt with it in a different way. Okay? We understood what our macro thing was, but we knew that a debt bubble could take years to collapse. Right? So we basically we're just trying to determine on our macro analysis, was the credit market expanding or contracting? All right, and that's all we really had to do. And then we had to determine, was that on a secular basis or a secular basis? If it was cyclical, we couldn't really do much to our portfolio. We still had to maintain kind of a balanced portfolio. We might have an uptick in volatility, but we still had to maintain some kind of balance. But when we began to notice that on a secular basis we were reaching some kind of apex, and I think we made that decision in kind of like mid-07, we began to really change our portfolio. That changed the way we valued assets. If we think that the credit market is expanding, we're in general going to think PEs are expanding. People are going to have more money. They're going to buy stocks at higher prices. If the credit market is contracting, it's going to go the other way. It's going to go the other way pretty quickly. So I always advocate when you're running money, understand the global situation, understand the economic situation. You know, what's GDP likely to do, and what is, most importantly, credit likely to do? Is it expanding or contracting? And that will help you allocate assets. It'll help you manage risk, and it'll help you value assets. So that's all I got. If there's no questions, we can cut out early for spring break. But are there any questions?
Actually,
Yeah.
on a couple slides back, you showed, oh, it was the, I guess it was interest rates, and then they made a distinction between the Iron Curtain periods, pre and post Iron Curtain.
Yeah.
Is that just because those countries could not buy debt? And why was it, is there a reason, was there a correlation to it spiking when you shut off that part of the market? Do you know the answer to that?
Yeah, I mean, it was basically the supply of capital. The supply, actually during that time, supply of capital was really being sucked there, you know, with the rebuild and everything like that. So I think that's real. Yeah.
So I know the yen is extremely strange situation now. So my question is when, not what will trigger yen to going weaker and weaker. So now it's getting stronger, but maybe in your opinion that will come to the other side. So
Yeah. Well, actually, the yen has turned, and that's kind of what we were waiting for. You know, when you see an asset price going down as precipitously it did, and there were other factors why the yen became particularly strong recently. When they had the nuclear accident, they repatriated capital back. We also think that maybe they're selling some of their Forex in order to finance asset purchases internally. So that would weaken the dollar and strengthen the yen. Okay, so two marginal things. So as we're seeing this thing slide, we're like, okay, we're watching it. Okay, we think that, you know, eventually, again, this is a secular change. Okay, so you never know exactly when it's going to happen. So you want to see some kind of evidence that something different is happening. And the one thing that looks to us like it's a little bit different is it's just simply bounced. Okay, it got down to about 76. And it's inverse, okay? So when it goes back up, that means the yen's weakening. Got down to 76, and now it's very strongly bounced off of that and got up to about 80.5. So that's the first indication that maybe these flows that have been strengthening the yen are turning around. The other thing that's happened is that they've shown, I think, 2 quarters straight of trade deficits. And they don't like trade deficits. So they may be becoming more and more anxious to do something. And the third thing is political. They're having a change in leadership, so we'll have to wait and see how that pans out. But that could affect it as well. So we haven't put the trade on yet, but we're real close, just because we've seen it turn, and we think some of those dynamics are changing right now.
So do you expect gradual change so for the next 3 or 2 years, or do you think something really big thing happen and turns really quickly?
Well, we do believe it's going to be a secular move. Okay, so there's no telling how far it goes. What we do think that is once it begins to turn, you'll see a rapid move to some level. It'll assimilate and then maybe be more gradual. But the yen, just in the last couple of years, has come from 120, down to 76. So we think it's got a fair way to go. Yeah.
You mentioned earlier briefly that government spending may have a negative multiplier.
Yeah.
When all is said, is that because of the waste and inefficiencies?
Yes.
So whatever positive there is, it's counteracted by waste.
Yeah, they, first of all, they spend money to build new road, right? And so the economic activity picks up. But then you don't need a new road for quite a while, right? So whatever, all it did was bring that into the future. So that would be kind of like, I would argue for a zero multiplier. The negative multiplier does come with waste and inefficiencies. Building a dam you don't need, or whatever, or subsidizing solar power. Okay, I put up solar just because they gave it to me. They gave me a 20% federal tax credit, which was cash. It wasn't even a credit; they just paid you cash. Then the state gave you a 50% tax credit. So, basically they paid for 70% of my system. On top of that, they penalized the utilities for not producing solar power. So based on those penalties per year, they go out and they buy credits. So they'll come to me and they'll say, hey, we need SRECs. So not only do I get to sell my energy to them, but I sell SREC credits to them that are going for about, they were going for about 2 to 3 times the price of energy. When you add all that up, it's still barely like an 8% rate of return. Now what we're seeing is that the state grants have all gone away. The utilities have found a way around buying SRECs. So the whole thing's kind of fallen apart. So what they've done, and without those subsidies, like oil pays, if you put $1 from finding oil in, you get $8 of energy out. With solar, if you put $1 in, you get $1 out, but that's with all these subsidies. Without all these subsidies, it's a completely erroneous solution, at least at this point. The solar panel is only 19% efficient. Maybe if it got up to 50% efficient, maybe it makes sense. So what we've done is we've built all these solar arrays, and they're inefficient. And so and it takes a gallon of oil to make a solar panel. So we've spent a lot of resources for something that just doesn't pay off. And that's a good example of how that is a negative multiplier. Anything else? Yeah.
You discussed briefly, I understand sterilization pretty well, but what's the difference between sterilization and immunization?
I don't know.
Kind of same thing.
Same thing, I guess.
Okay.
Yeah, I don't know the terms, or I don't know what immunization is.
Oh.
But
Thought you said it.
maybe I said both. But it's the process by which they basically manipulate currencies so they're locked in fashion. China does it every day. They want to keep the yuan directly at a certain price, against the dollar. So anytime we buy something from Japan, they've got to sterilize that currency transaction.
And can you say immunization too?
Sure.
Okay.
Yeah.
I think is the major factor behind Japan's debt. Is the earthquakes, the government's effort to stimulate the economy, or the rising commodity prices?
Yeah, it's been years and years and years. They're the greatest inflationists who ever lived. Okay, just by definition, if they're printing yen, they're encouraging debt, and that's what they do. But so the very process of immunization creates debt, and there's a lot of factors. I mean, a market is chaotic. Okay, there's so many variables. And that's what makes it so difficult. The variables themselves change. So you never can really rely on any particular relationships. But if you go back, Japan had a great economy in the 80s. But what did they do with all their income? What they did was they bought a lot of real estate and businesses in the US. If you went to Hawaii, most of the people there were Japanese travelers. But what they did is they bought, Pebble Beach, they bought Rockefeller Center, they bought a lot of companies. So in other words, they took the yen and they invested it in dollars. Then what happened was you had the '87 market crash. And what happened was the dollar weakened significantly against the yen. So every dollar they bought when they brought back into yen was worth less. Not only on a currency basis, but when they went to sell Pebble Beach and Rockefeller Center, they sold it for half of what they paid for them. So it was like a huge infusion of capital or movement of capital out of Japan into the United States. In fact, I believe it did a lot of, it went a long way in keeping us from going into recession. We never went into, maybe a small one, but we never went into recession in '87 because we got this big boost from Japan having to sell assets at a discount. So in essence, a lot of, whoever owned Pebble Beach sold it at $2 billion and bought it back for $1 billion. It was a great trade. And that difference was huge amounts of capital infusion into the United States. So I think that's what really set off Japan going into a depression and us not going into recession at that particular time.
Yes, I know we're short in time, but so going back to the U.S., and it's probably a combination between both alternatives, but what are your thoughts in terms of getting out of this hole? Do you see it more leaning towards contraction of the credit pool, or sort of maintaining the credit pool artificially until real production expands and it sort of matches up to that credit pool?
Yeah, more the first, because you would need he's right, there's two ways you can get out of this thing. Let the debt implode, let the bondholders take the losses, let the banks take the losses, let prices come down, okay? My first job was in 1982. I took a job with Interfirst Bank of Dallas. Okay, nobody remembers that bank because it's now bankrupt. Right? At the time, it was the 8th largest bank in the country. Oil was at $26 a barrel. Okay, I went down there in their little credit analyst group, and we were just crunching numbers. All of a sudden, the Iran oil embargo ended. Oil went from 26 to 13 in 2 weeks. All those loans were made based on collateral values and oil prices at $26. So all the banks who were heavily levered went bankrupt because their collateral values went 10 cents in the dollar, and their loans weren't being paid back. Right? What happened was, over the next 5 years, prices dropped significantly in Arkansas, Oklahoma, and Texas. They dropped to a level that released capital. In other words, there were still guys who had money. They were just saying, I can't buy that property and put a store on it and make money. Prices are too high. But when prices got 50% lower, all of a sudden that capital said, hey, I can buy this property, and I can build a store and hire people, and I can make some money. So capital was released. It's all about price. So the government is insisting on us keeping prices up here, stock prices, real estate prices, everything up here. All right, Jim mentioned it yesterday. Let the prices go down. Let them clear the market. I mean, would anybody here mind paying less for stuff? I don't think so. The only people that would really mind are the bankers. So let prices drop. Yeah, wages would come down, but there is a place where you have full employment. I can go into a lot about the artificial wages and the minimum wage and how that reduces the full employment number. But the basic answer is you let prices drop, you let the market correct. That's going to clear the problem. It's not going to be fun, but it's also not going to last 20 years. It's going to last 1 or 2 years. And then things will get off again. The other way is to try to keep things going for some period of time, but you need a massive productivity gain to create enough income. And that massive productivity gain would have to be exportable. So we would have to come up like with the 100% efficient solar cell and sell it to the rest of the world, and that could solve the problem. But it would have to be a massive productivity event, given the level of debt. And the other thing is, at these level of debts, you can't inflate your way out. Look what happens. We have debt of 350% of GDP. Everybody's talking about inflate. Well, what if interest rates rise as the result of inflation, and we start paying another $200, $400, $500 billion in interest a year? So those who say we can inflate our way out of this thing, I don't think really have thought this thing through.
So from a consumer standpoint, it's not going to bother me if prices fall, but as somebody who's going to be paying about $1,000 a month in student loans for the next 15 years or so, it bothers me a lot if prices and wages fall a lot. And if that happens, my consumer demand is going to get severely depressed, which is going to drive prices down even further, I mean, how do you get out of the deflationary spiral that occurs? I mean, considering how much debt people are already carrying.
Yeah.
I mean, what's
Yeah, well, what you're arguing, though, what you're arguing is against them continuing what they're doing, because all we're doing is making that problem that you just said worse and worse and worse. You know, as we now are lending, you know, giving student loans to 50-year-olds who have no job, they got no shot. You know, if I got two people, a 50-year-old and a 30-year-old, and they got the same skill set, I'm hiring the 30-year-old, not the 50-year-old. So by delaying this problem, we're making it worse and worse and worse. I hear what you're saying, and it's going to be nasty. It's going to be ugly, right? But you have to rely on the productivity, the natural productivity of the country. Yes, people are going to lose their jobs. Yes, wages will go down as a result. But at some point, you got to say the debt's enough, and we can't support. And we can't support the level of debt that we have right now. So there is no easy answer. I mean, you know, it's an ugly answer. But all I'm saying to you is that as we forestall this thing, we're just creating more public debt. And if interest rates go up, you know, then we're really cooked. So we've got to start doing something. And you know, I think, you know, a lot of people don't like Ron Paul for his foreign policy or whatever, but I think he's exactly on as far as government. We've got to cut government, which tends to be very inefficient. We've got to cut it dramatically. Not 10% here or 10% there. And the other thing is, you know, I haven't even mentioned the unfunded liabilities that we have, Medicare and Social Security of, you know, $100 trillion. You know, that's going to have to be adjusted, and it's going to be adjusted dramatically, which is going to reduce consumption. You know, people haven't thought that one through. What if, you know, I'm expecting a Social Security check starting when I'm 67 years old. If I find out I'm not going to get it to 75, I'm cutting back on my spending. You know, so there's no easy way out. But at some point, we have to get back to the reality of what economics really is and how it works. And we're not even close. Is there any more questions? Okay.